This is Anthony Nunez, and I'm here once again doing an educational video. Today is going to be about how much is the property going to cost me. So when you're doing your research online and you're seeing all these properties, how much is the property actually going to cost per month, right? How do you do the math? So the way that many professionals do it is calculating the P.I.T.I. So you'll see that term, the acronym thrown around, and what it stands for is principal, interest, taxes, and insurance. When you add up all of those costs, you will get your monthly payment. Okay? Now, if you've been looking at properties online, one thing to keep in mind is that several websites online are usually inaccurate when it comes to the taxes and insurance. Okay? So you're going to want to talk to your professionals in your area to make sure that you get the exact figures, right? Once again, the websites online, most of them, when you do a simple Google search on a property, odds are the top few websites that pop up are going to have inaccurate taxes and insurance data. So you're going to want to double check those numbers with your professionals in your local areas. However, the mortgage, so once we get down to calculating this number, the mortgage, which you can check on a simple mortgage calculator, and your mortgage broker or the bank can verify your rate, whatever rate you're going to get. All right, the mortgage is going to be a combination of your principal and your interest. Okay, when you start off your loan, you're going to be seeing that you're going to be paying a lot of interest, but as the years go by, it'll slowly become more and more the principal, because you're going to be paying down that loan. So in essence, you have less, you owe the bank less. That's why you're going to see a shift to paying more of the principal the further into the loan you're in. Okay? So in this case, we're going to, for the sake of practice, say that our mortgage will be a $2,000 per month mortgage. Okay? When you look up the tax information and you get the accurate tax information, it's probably going to be listed for the year. So let's say we're paying $6,000 for the year, then you're going to have to divide that by 12, okay? Because 12 months. So $2,000 per month for the mortgage, $500 a month for the taxes, okay? Now the insurance numbers are going to vary. They're going to vary based off the person. They're going to vary based off the location of the property and whatever the insurance company assumes as risk. For example, flooding, right? So flooding is a very common upcharge in the insurance, all right? So you're going to want to check into that. And let's say I took a number that's on the low side for the Northeast, but let's say it's $1,200 a month, okay? So at $1,200 a year, it will be $100 per month, which it's probably a little higher in the Northeast, okay? But $1,200 a year will be $100 per month, okay? So when you add up the mortgage, which is the principal and the interest, the taxes, which is the $500, and the insurance, then you get your total monthly cost. So a person looking to buy this particular property would be paying $2,600 per month. Now, that's assuming that they put 20% down when they bought the house, okay? Also, the websites that you may be looking at are also assuming that you're putting 20% down. That's why in most cases you will have inaccurate data. If you're relying on those websites, you're going to want to talk to the professionals in your area. If you put less than 20% down, you're going to be paying what's called PMI, which some people avoid like the plague. All right? PMI is private mortgage insurance. That's an additional insurance that the bank will charge you to supplement the loan, right? So if you're putting less than 20%, you'll see a PMI charge. You'll want to talk to the mortgage broker or the banker, because a lot of them are trying to be slick and they're offering now these PMIs for the life of the loan. Okay, those are usually tough deals. Try to get out of those deals. Okay, unless you're getting a really, really good rate, right? Unless you're getting a rate well below that's going to offset the PMI, I would try to avoid it. It used to be that the PMI would be for 10 years. So you would see the banks try to put it for 10 years. I'm seeing more and more the banks are strategically shifting to loans for the life PMI for the life of the loan. Now, why is this a problem? Because at some point you're going to want to refinance out and get the PMI off, which the bank will love because they'll get an additional set of fees that they can charge you. So it's better to avoid the PMI if you can. If you can't, still buy the property. It might still be better to building your wealth and building equity than not owning a property and renting. However, just be mindful that there might be a PMI charge. This is for a regular house. If you're looking for co-op and condo data, please look at a prior video that I created comparing co-ops and condos where I have a chart and I show you how the monthly expenses will break down with co-ops and condos.